Many investors are trying to figure out where the U.S. sits in the current business cycle. Among other things, stock investors look to the business cycle to help them predict earnings growth and also to determine the relative appeal of different market sectors. For bond investors, the business cycle position can shed light on inflation and interest rate expectations. The business cycle represents the wave-shaped ups and downs that the economy goes through. At its simplest, the cycle comprises of an expansion, a peak, contraction, and trough. The average U.S. business cycle, from one peak to the next, has lasted nearly 6 years. If the recovery from the last recession were typical, GDP growth would have been stronger over a shorter period. But the last recession, known as the Great Recession, was not typical, so we shouldn't be surprised that the recovery hasn't been typical either. Another issue during this recovery is the partial decoupling of the U.S. and European economies. As slow as the expansion has been here, it's been even slower in the Eurozone, where some of the large members are either in recession or teetering on the brink. Germany, the Eurozone's economic engine, is essentially stagnant. Due to the Fed's intervention, it's possible that treasuries are already too pricey, though no one can know how long it will be before a retreat in prices and a corresponding rise in bond yields occurs. That is your investment for this week, and we will see you next week.